Welcome to the C-Suite Series presented by Channelchek and Noble Capital Markets. Noble is an SEC-registered FINRA licensed broker-dealer and the source of the equity research available on Channelchek. Of the 6,000 small and microcap companies listed on the site, today we're featuring EGLE Bulk Shipping. Poe Fratt, Noble's senior research analyst covering the company, will be interviewing CEO Gary Vogel. Afterwards, he will be joined by Michael Kopinski, Noble's Director of Research, to discuss the key takeaways. As a reminder, Poe's research is available at no cost on Channelchek. Just type in EGLE Bulk Shipping in the top left Company Data section. And now, here's Poe and Gary.
Good afternoon. This is Poe Fratt from Noble Capital Markets. With us today, we have Gary Vogel, the CEO of EGLE Bulk Shipping, one of the leading dry bulk companies in the world. Gary, thank you for joining us. Why don't we start off by describing sort of how the first half of the year, which looked pretty challenging, went, and then you sort of set expectations as we look towards the end of the year.
Absolutely. Well, first of all, Poe, thank you for giving me the opportunity to join you today. Very much appreciate it, giving me the opportunity to talk about the dry bulk market in general and EGLE more specifically. So no question, 2020 has been challenging and completely unexpected from where we started the year. There was a lot of optimism on our part given the entry into the year with IMO 2020. I think we'll probably talk a little bit more about that and exhaust gas cleaning systems. But the onset of COVID-19, we actually made it through the first part quite well through the shutdown in China and the extended Lunar New Year holiday. But really what we saw is the second half of March when Europe and the United States and really the world in general started to shut down in terms of port restrictions. And so what we had was both a lack of cargo demand, but also the inability for cargo to get to ports and get onto ships. So it was pretty steep decline from March into May, as you pointed out. And what we've seen is a pretty nice recovery here where rates today, our index is at 10,500, really back where we started the year. So it's been anything but a straight line from those 2 points, but we're now at a situation where we're seeing demand come back, and certain cargoes in particular are behaving quite well.
Yep, that's great. You talked about the recovery or the rebound that started in June. It seemed to have been led by the major bulks. And now it sounds like minor bulks might be picking up a little bit and, looking into the grain season. Is that your sense? Has the minor bulks caught up and recovered, or do you think there's still a lot of potential there for them to recover even more?
Yeah, I mean, the larger sizes, particularly the larger ship sizes, the capes, which carry us iron ore and coal predominantly, are the most volatile. So you see that first in terms of both, of course, the precipitous downturn, but also the recovery. Minor bulks, and you mentioned grain, has been extremely strong as of late, which is the third major bulk actually. We've seen significant return of cargoes in aggregates, building materials, gypsum. The one thing about minor bulks is it's a myriad of, it's everything other than the three major bulks. And so we've seen a nice return. I think you could look at it as three ways. One is a restocking for cargoes that weren't moved during April, May, June. So a restocking of stockpiles. Then secondly, a return to normalcy of demand. And then on top of it, stimulus. And we see that particularly in China, where they're really leading the return, if you will, and a lot of stimulus. And part of that goes into infrastructure and build, which is beneficial not just on the major bulks, but the minor bulks as well. So it's nice to see it. Really, we're seeing a participation across many commodities, but also many geographies as well.
Great. If we could talk about just the overall dry bulk market, if you look at the last 2 years, they've been somewhat similar, pretty weak first half, and then a better tone to the second half of the year. But investors often comment about the volatility of the market and how unpredictable it is. And it doesn't seem like seasonality is going to go away. Do you think there's anything that can change the market structure to temper volatility and increase predictability?
Well, I mean, first of all, you mentioned, right, seasonality, and that's driven partly the most obvious in that would be the grain in terms of harvest, right? North American harvest, Northern Hemisphere harvest, being summer into fall, and versus South America being spring primarily. But then you have other things as well that lead to that volatility, congestion. So when you have congestion, but also an unwinding of congestion leads to supply coming out or going into the market, and then geopolitics and weather and things like that. So volatility is part of our market. At EGLE, we are an active owner operator. We deploy our fleet ourselves, carrying cargoes on voyage basis. We can talk a bit more about that. So we actually welcome the volatility, and all with a view to return above market returns compared to the index. And so for us, working around that volatility, mitigating the risk around it using FFAs, forward cargoes, arbitrage, and things like that gives us the ability to outperform. And sitting here today, I'm pleased to be able to say we've outperformed that index in a meaningful way in 13 of the last 14 quarters. And, a lot of, you can call yourself an active owner operator, but ultimately it comes down to that outperformance. And it's also important to be a bit granular, because outperforming a Supermax index, which is based on a 58,000 deadweight vessel, with an Ultramax isn't a fair comparison. So when I say we outperform, it's on an adjusted basis, where our Ultramaxes, we need to perform even better than the index, and some of our smaller, older vessels are lower than index, but it's adjusted. So that's real value add that EGLE's putting on the balance sheet. And the aggregate, it's about $77 million over the last 3 years.
Great. I like that strategy to embrace volatility. But it would be nice to see, outperformance in a strong market or a firmer market. And I was wondering, what's your view on consolidation? Do you think that would help the market structure at all?
Yeah, I mean, consolidation is definitely something we talk about, and we've talked about for a long time. I would bifurcate consolidation into two aspects. One is the capital markets, and I think we can all very much agree that larger market cap, more liquidity, lower cost of capital are all positives. And from that standpoint, we're quite supportive of consolidation. When you look at the commercial side, we're the third largest owner of Supermaxes and Ultramaxes. We own 50 vessels. And yet we're less than 3% of the market. And so it's going to be a long time before a company gets the scale in a certain segment within dry bulk, to have, pricing power, if you will. Having said that, we think that, good custodians of capital and assets are should be natural consolidators. I talked about our outperformance. The other thing we're proud about is our governance. We're in the Weber scorecard out of 50 public shipping companies, we're number one. So good governance, transparency, as I said, good stewards of shareholder capital, we think makes us a natural for being part of that consolidation. And hopefully we'll see more as we get into a recovered market going forward.
Great. We're 9 months in or 8 months into IMO 2020. That was the big regulation that was overhanging the market for the past 5 years. Are there any other regulations that are on your radar screen? Any alternative fuel prospects or propulsion technology that's on your radar screen, Gary, that you're looking at right now?
Absolutely. I mean, I think a reduction to zero emission vessels is the next big thing, right? A reduction in carbon, and there's no question. We're very supportive of that. We're members of the Getting to Zero Coalition. Having said that, we operate, as I mentioned, in carrying minor bulks as well as major bulks, calling on hundreds of ports. So what you'll see is the supply of the fuel is a really important part of this. It's not just building a ship with an engine capable of an alternative fuel. And so what you'll see is ships that return to the same ports on a regular basis are the first movers. They're able to be. So if that's whether it's ferry, going back and forth between two ports, liner vessels, cruise vessels that return to the same ports week after week, where you can set up that type of infrastructure. We literally have vessels that will call on a port and not go back there for 5 years. And so it's much more complicated to apply that type of alternative fuel to Supermaxes and Ultramaxes. So we're very supportive. We're here to be there, but it won't be Supermaxes or even Ultramaxes that are going to be able to be the first movers, but EGLE will be at the forefront within our size to do what we can because we think it's an imperative for the industry, and for the world in general.
Great. And then just one last question on sort of the macro before we talk about EGLE bulk shipping in particular. What's your biggest surprise this year?
Well, no doubt COVID-19 is the biggest surprise. I mean, hopefully no one saw that coming. I mean, we went into this year really positive. We had 37 retrofits, 41 scrubber fitted vessels effectively ready for the beginning of IMO 2020. And really positioned, not to mention 20 Ultramaxes we acquired over the last, 3.5 years in a fleet renewal program. So we felt really good, and we felt also that IMO 2020 would mean higher fuel prices, meaning ships would slow down, taking effective supply out of the market, and the older and least efficient vessels would be, it would be a catalyst for them to recycle and scrap earlier. Unfortunately, COVID-19 hit, and even before we get into the discussion on the OPEC Russia, oil price war, we saw effectively the spread narrow on those fuels, the fuel spread narrow, because the competition for mid distillates, there was no planes flying, first in Asia, then globally. So really that competition for the mid distillates for very low sulfur fuel, which the non-scrubber fitted vessels need to pay for, went away and the price came down. So the biggest surprise is really that it just didn't happen. Fortunately, on our side, we put on pretty significant hedges as the fuel spread started at over $300 in the early part of the year. And as we talked about on our last earnings call, mark to market, and some of which we've already taken monetized $10 million in value on those spread hedges on our scrubbers. And even in the current fuel environment, if we look at next year's futures right now trade at 95, that's about $15 million of incremental cash flow for us. So this year together, that's about $25 million on what was about a $90 million investment. So nowhere near as positive as we expected, but I think by any metric, those kinds of cash flows on an unlevered basis are pretty meaningful, especially in what's been, as you pointed out, a challenging first half of the year.
Yeah. It sounds like that might qualify as your biggest disappointment, but what is your biggest disappointment this year?
Oh, you just said it. I mean, that would be it. The year just hasn't been as we expected. And dry bulk has endured quite a few, if I can say, black swan events over the last number of years. We had the Asian swine flu, which had hindered soybean demand, which is a significant driver for us, particularly on our Ultramax vessels. Going into China. There was a Vogel dam collapse, which didn't affect our size directly, but clearly very negative, impactful to the larger sizes, and there is a cascading effect in that. Trade wars in general, not good for international trade and growth, and then this year COVID-19. So we're ready for a white swan event, but really a more normal environment, because we think the supply side continues to look good. It actually looks better today than it did even at the start of the year. So if you can look at it really as maybe 2020 has delayed what we felt would be a good environment into the latter half and maybe 2021. But the supply side has never looked better. Its supply is 5% of the on the water fleet in the Supermax Ultramax segment. That's the lowest it's been since it's been recorded. And really it's going away quite quickly. So over the next 6 months. So we think next year the supply side looks really good. And we also think while demand is negative this year, that's really front loaded, particularly into the second quarter. So we combine that along with what I think is a developing bullish case for crude prices and a return of demand for mid distillates from aviation returning. We think the forward has a lot of positives that will bode well for dry bulk and Supermax Ultramax in particular. So I know you asked me for my biggest disappointment, but I'd rather turn it to where we see the future, because we think it's quite positive.
Yep, absolutely. Have full. If we look at EGLE bulk shipping in particular and focus a little more on your strategic shifts that you've seen over the last couple of years, especially since you've been there, there are two that seem to be fairly major. One is the fleet renewal program you mentioned, and then also the second one would be, your more active management of your fleet, less selling time. Let's talk first about the fleet renewal program. What was the catalyst for that program? What drove that decision? And, how are you positioned going forward?
Yeah, so it absolutely was an imperative from the beginning. I mean, this week actually marks my 5 years with EGLE. And when I joined the company, our fleet average age was 9 years. And if we hadn't done anything today, it would be 14. Obviously, simple math. But our fleet today is the same age as when I joined. And so fleet renewal is important for two reasons. One, because ships continually get older. And two, we wanted to focus on the newer generation, the Ultramax, which are larger, but also importantly more efficient. So every time we've bought an Ultramax and sold one of our older Supermaxes, we've gotten more efficient ships, more environmentally friendly, and more commercially viable. And it leads into the next section. You asked about the active owner operator model. We need to deliver on that value proposition, and having older ships makes it more difficult to do that. So when I joined, we had 43 ships. We now have 50 vessels in the fleet, 49 pro forma for the Golden Eye, the most recent vessel that we sold. But we continue to look to selling the older, least efficient ships and buying newer ships. And when I say newer, we haven't done any new buildings since I joined. I've been quite vocal. I think the world has enough ships right now, so we focused on 0 to 4-year-old Ultramaxes that we've purchased, over the last 4 years, 20 vessels, and we've sold 14, now 15 vessels.
So it sounds like, Gary, with probably several more, close to 20-year-old vessels that you own, I think 5 or 6, it sounds like the fleet renewal program is ongoing, and that it is likely never to end just because of that age factor.
Absolutely. I think, in a perfect world, I think EGLE's age is a good one on average. Call it the 6 to 9 year, 7 to 9 year old average overall. But really, perfectly, I think 15 years is probably where we'd like to see ships disposed of, given market conditions. And a more robust market in 2020, I think you would have seen a quicker disposition of some of those older ships. But we continue to do it on a ratchet basis, where we sell 1, 2, 3 ships, we buy 1, 2, 3, 4, things like that. So we'll continue to do it methodically, but also taking advantage of opportunities within the market, as they present themselves. We've done a number of on-block transactions last summer. We did 6 ships, which were 4 and 2 from 2 different private equity back groups. So a little bit back to your consolidation, not public to public, but at least consolidating those ships into our fleet. And I think we continue to look to do that as well.
And then, the second shift would be, as you mentioned, the adding more value to your fleet. And can you talk about just maybe a couple of examples, or give us a couple of examples of exactly how you add more value to your fleet instead of just selling the time into the market? How do you add more value? How do you generate that rate outperformance?
Yeah, absolutely. It's my favorite topic. So I'm happy to take as much time as you want. I mean, we like all of the companies, we have a significant amount of capital committed, to these vessels, and our basic thinking behind it is, why would you give your ship to someone else to garner a premium that's available, as long as you have the ability and the knowledge base and the people and willing to commit the time to do it? And that's the active owner operator model. And this, I mentioned, I've been here 5 years. I've been in dry bulk for 32 years, and really this is something I've been doing most of my career. So as that active owner operator model, which is led by Bo Westergaard, We have offices here, Europe, and in Singapore, and every ship has a par value, every cargo has a par value. That's the index. And we book forward cargoes. We also, when we charter out ships, and anyone charters out ships, there's always an optional period. Much like when you rent a car, you can bring it back within an hour or that last day. Ships are the same way, but when you lease a ship out and you give someone the opportunity to return that ship in about 9 to 12 months, there's a 3-month window, and of course that option's used against you. In a high market, you don't get your ship back. In a low market, you do. We don't like to do that. We like to be on the other side of that. So by keeping the ships ourselves, we don't give away that opportunity. We book cargoes, and if we reel out a vessel on time charter to someone else, we lose that asset. But if we book a cargo for a ship, we can use not only that ship, but we can use any of the 50 ships we own, but we also can charter in any of the 3,500 geared vessels in the world. So all of a sudden we have optionality. And when we charter in one of those ships, we can do it for a voyage, but I mentioned that optionality when you charter a ship in. We may charter a ship in for 3 to 5 months against a cargo where the first 60 days are covered. Now I only have 30 days that I have to cover, and then I have another 2 months of optionality. And we may sell a derivative, an FFA, a forward freight agreement, to cover that fixed period and have the free option at the end. So these are all, again, just scratching the surface of some of the ability in which we do that. And another example, and then I'll stop there, is we may have a ship coming in with a cargo into the US Gulf. Let's say it's coming into the Texas Gulf to discharge a cargo. We may see an interesting cargo out of the Mississippi River, which we will then book. But instead of putting that cargo on the ship, we know we can. We'll look for another ship in the Mississippi River. That way we avoid the ballast from Texas Gulf to the Mississippi River. Conversely, we'll look for a better cargo out of the Texas Gulf, knowing we'll have to find another ship for the cargo. So it's that arbitrage between ship, cargo, and derivatives that gives us the ability to garner some of that extra premium. It's a multi-strategy approach. There's a myriad of other examples within that, but it's all based on the tenet that every ship has a par value, every cargo does. There's a forward curve, and we work on a risk managed basis to outperform that index.
Great, thank you. And do you think that the strategy, you've highlighted it as a competitive advantage. Is it a durable competitive advantage? We've heard more and more people, more and more companies, talking about this, cargo focus and talking about adding value and generating TCE rate out performance. Do you think it's durable?
Well, I absolutely think it's durable. I know that I mentioned the $77 million that's on the balance sheet, or wouldn't be there without it. So it's absolutely durable. I also mentioned I think it's important that it's done on an objective basis, so a fair comparison to the index, which we do. Every single quarter in our earnings call, we put out a graph all the way back to 2016 when I joined this company, of the BSI on a net adjusted basis and our performance, for better or worse. I believe we're the only company that actually does that, and so I think it's important. It's not what you call yourself; it's that actual performance. Ultimately, I do believe that we should be able to have a premium in terms of if NAV is the metric on which people are looking at share price, there should be some premium, a multiple on that outperformance, given that we now have a track record of over 3 years of doing that. Ultimately that's up to the investors to do so, but no doubt about it, everyone can value a dollar, and the value that we've garnered and been able to deliver so far, I know today sits on our balance sheet.
Okay, and then if you look at sort of your fleet and how you've not only renewed it, but you've also enhanced it from the standpoint you were an early adopter of scrubbers. Have the scrubbers, operated as expected? And do you see the scrubbers also as a competitive advantage? And are any customers coming to you looking specifically for scrub capacity?
Yeah. So starting with your first question, the scrubbers have worked as designed quite well. Early days, some issues around some of the technology, but never to a point where we couldn't use a scrubber on a voyage. So technicians in a port working, things like that. But as with any piece of new equipment, I'm pleased to say they've all worked quite well and above design expectation. There's a competitive advantage because we can deploy our assets in trades that are particularly well suited to more time at sea, as they're more efficient vessels because they burn less expensive fuel. So there is an advantage, and there's clear an advantage in that we have the largest scrubber-fitted fleet of Supermax, Ultramax vessels with 41, as opposed to having 2 or 3 vessels. So there's an advantage to us because the cargoes we're booking forward really are around that, because that's 80%, more than 80% of our fleet. Excuse me. In terms of charters asking for scrubber-fitted tonnage, I'd say they're agnostic. Most of our charters don't know when one of our ships shows up whether it even has a scrubber or not, because when we book cargo in the future, all of our contracts, none of them stipulate scrubber-fitted, that we want a scrubber, we don't want a scrubber. Certain areas where you can't operate them, that would be up to us to burn low sulfur fuel and not use the scrubber if it happens to be in a port where there's a restriction, or water is brackish or fresh, things like that. But otherwise, it's really an internal. One of the questions I often got, and I got a lot of questions before IMO 2020, but one of the questions I often got was, how much of that scrubber premium are you going to have to give away? And I said, I don't think we will. And I'm able to sit here today and say we don't give away any of that premium. What we pay for fuel is an internal cost on voyage basis. So when we go and bunker a vessel with HSFO and scrub it down instead of very low sulfur oil, that bill is ours, and it's an internal one. So what we get paid for freight doesn't change whether we have a scrubber fitted ship or not. And when it comes to reletting a vessel on time charter, which we do some of when we're getting what we feel is fair value for it, if we don't get fair value for the ship and the scrubber based on market, not to mention that optional period you're giving away in it, if we don't, then we simply won't do it. And very quickly, I think the chartering world out there, including operators who like to take ships on time charter, know that on an EGLE scrubber fitted vessel, if it's full value for that scrubber, or that vessel won't be relet into the market.
Okay, if we could shift from operational a little bit more, or ask one last question there. I mean, how have you been handling crew changes? I've heard a lot about, just as you mentioned before, port restrictions and other things. How have your crew changes gone, and have you changed anything as far as how you're handling those crew changes?
Yeah, well, it's an extremely fluid situation. So in April, May, no crew changes took place whatsoever. So there was started a building of a backlog of people who had been on board ships beyond their contractual period, then beyond the grace period, if you will, and even longer. Fortunately, things have opened up, and countries have supported the fact, many countries, that this is a crisis and needs to be dealt with, not just for EGLE, of course, but for all the ships around the world. To date, we've done about 500 out of our 1,000 seafarers in terms of crew changes, the lion's share in the last, month and a half. But it's changing all the time. Hong Kong was open to crew changes. As of today, it's closed unless you're doing cargo operations there. Singapore was more open, now has some more restrictions. But we're also finding other places we never would have changed crew before that are open to it and allowing it, some with quarantine, testing, things like that. So it really is bespoke depending on where you're doing it. And I really have to, hats off to my colleagues who are on top of this, because it really is changing every day right up to the moment when the crew change gets affected. And it's not just getting new crew on board, it's getting the old crew that's getting repatriated, not just off the ship, but then to airports and back to their country of origin. So it's been heavy lifting for every owner out there, but we're making good progress. And clearly with 500 over the last couple of months, I feel good about the direction it's going, but it's changing all the time.
Great, thank you. And then if we could shift away from operational and just look at your capital structure and your balance sheet for a second. It seems like you've done a good job of managing maturities, managing your annual debt amortization. The only thing that I think investors are looking at is that you do have some high cost Norwegian bonds outstanding. And what would be the catalyst to refinance those?
Yeah, I mean, there's two things. First, we have about a little less than 2.5 years left on that. So, having said that, as you mentioned, the coupon is higher than the rest of our debt, but it also came with lower amortization, and it tended to have the older vessels we talked about earlier in it, all of them. So there was a reason for that. I think the catalyst for a refi would be one of two things. First of all, I believe that every time we've done a refi in the last 4.5 years, we've improved our capital structure, whether that be through the cost, the margin on the debt, flexibility, things like amortization or tenor, things like that. And so that's one. When we look at something, are we improving that cap structure, of course? And second would be a transaction. And I'd like to believe that there will be a transaction, a meaningful enough of a transaction that would act as a catalyst to do something. Because as given a little less than 2.5 years, we really have 1.5 years to likely want to do something before 12 months out. So, I guess I would leave it with watch this space. We're comfortable with it, but likely do something before that time frame, without any specifics.
Great. You've been busy over the first 5 years. You've improved the fleet. You've changed the operating strategy to add a lot more value and actively manage the vessel capacity that you have. And then thirdly, you've improved the corporate governance and really become a leader in the industry for that. Gary, what's your challenge over the next 5 years or next 3 to 5 years? What's your greatest challenge ahead?
I mean, the one thing about this business is you never know where that next challenge comes from. But as I sit here today, I feel really confident as we look forward into, call it the back part of 2020 and then into 2021. So the challenge is execution, and that's a really broad umbrella, right? Execution on the daily, adding that incremental value to show it is durable, to show investors that there's real value in EGLE as a competitive advantage to others, to grow this fleet, not just for growth's sake, but to grow it because we're able to add value and we're good custodians of the assets. So the challenge is to continue to do what we've done. We're proud of what we've accomplished, but it's an evolution, and so we need to continue to improve our fleet, renew our fleet, grow our fleet, get better at our operations across the board. And of course, deal with the challenges as they come, whether that be commercial or regulations or unexpected events like we had this year with COVID-19. So I'm not worried about coming in and being bored. There's always things. I think we're well situated to not only handle them, but to capitalize on those as they come forward.
Perfect. Well, I really want to thank you, Gary Vogel, for joining us this afternoon. And I really appreciate your time and your thoughts on EGLE Bulk Shipping, in particular, and in general, just the overall outlook for the dry bulk market. Thank you very much.
Thanks, Paul. I really appreciate the opportunity to speak with you today.
Well, Gary seems very sharp, Poe. So it's interesting what's going on in the landscape post-COVID, but there's a couple of things that I would like to ask you about. It sounds like Gary plans to keep a relatively young fleet. Do you think that he will grow the fleet over time or just replace the older fleet?
Yeah, Gary is one of I think the best operators in the industry. And, when you look at his fleet renewal strategy, I think they've done an excellent job. And I do think looking forward that, that it will be an ongoing program, and that I think the bias is to grow the fleet on an opportunistic basis. As he mentioned, he just doesn't want to, own an asset. He wants to add value to that asset. So it'll be based on, his view on whether he thinks at the right price, he can add value to that transaction going forward.
And it sounds like the competitive landscape is changing. And Gary mentioned that the competitive advantage that he has is durable. What do you think about that statement?
Well, I think that imitation is the finest form of flattery. And what we've seen is a lot of other dry bulk companies, mirroring the strategy that they've implemented over time. And I do think that, it's durable from the standpoint of each asset is an individually managed asset, and it has a scenario or a couple different ways to add value. And, they're going to continue to look at ways to add value, not just sell, not just doing time charters. If you look at it if you just do time charters, you only have a finite amount of days to sell your vessels into the market. And that is not going to generate a lot of outperformance unless you're really good at timing. And I think with the strategy that they have of adding value and looking at different ways to, manage their fleet, pick up a cargo here, drop off a cargo there, or charter in a vessel to manage their cargo needs, I think that is durable, and I think it's going to continue.
He painted a pretty positive fundamental outlook with it sounds like rates have returned to kind of pre-COVID levels in some instances, and he just had painted a pretty positive level for the balance of this year and into next year. What do you see as the upcoming catalyst for the stock?
I think one, it's a continued, rate outperformance. If they can continue to outperform the indices, and he's a pretty tough judge of outperformance, and if they can continue to generate that consistently, I think that'll help. Secondly, if they continue to make progress on renewing the fleet, it's hard to time when transactions are going to happen, but I think if they can do a couple more acquisitions and even further enhance the fleet and potentially even grow it, that would be a catalyst. And then you also have some, high cost debt that's due in 2.5 years, as he mentioned. And I think that could be a potential catalyst if they can, do that combined with an opportunity to grow the fleet. I think that could be a catalyst over and beyond just the overall, better tone to the dry bulk market as you look out into 2021. As Gary mentioned, the supply situation, the supply outlook looks very favorable. We're not seeing a whole lot of new builds. We're also seeing an aging of the existing fleet. And, I think that is very positive for the industry looking into 2021.
Well, thanks, Poe. This is a very interesting company and fascinating perspective of the industry as well. Thank you so much.
Thank you, Mike. It's my pleasure.